Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello everyone. Before we start the solution, few things to discuss with you. Firstly, to prepare the solution, to discuss with you requires a lot of effort, time. It also requires clarity of concepts, and it also requires a lot of courage because we also can make mistakes as faculty. So if you find any mistake, don't just randomly troll us. You can put down what is your query in the comment section and I will be more than happy to address that. Second thing, this question paper was a lot on in-depth concept testing. Now, if you look at it, one of the questions which was on core inventory, I bet a lot of you would not have been aware of this core inventory concept. Of course, unless if you have taken classes from us where we have discussed, even if it was a 2-mark question, Institute is actually going into depth of concept. That is one thing. Second thing, they have also picked up some questions like from example accounting standard. Only issue is here it is fair value of identifiable asset. I have a problem with the question where they have used the term fair value of net identifiable asset. Okay, so that is what makes the question slightly incorrect, but still we can solve that in the examination. Then we had some questions which were simpler, like the question on inventory. Now this I have been telling in the class, MP1, MP2 question. If at all they ask from inventory, in inter or in final, this is one of their favorite questions. Then there was a question on machinery account. Now this machinery accounting, though it was a lengthy question, even at a foundation or an inter level, students would have been able to solve it. Similarly, question on interim financial report that picked up from CA Inter. So it is not only about passing a CA Inter exam, but also being able to absorb the concept when you come to the CA final level. Right? There is a brief background, I would like to discuss with you. And yes, if you like the video, if you like the solution, if the solution is helpful, please consider liking the video, sharing it with your friends. And if you have any query, you can put down in the comments. We have already released AFM solutions. You can also have a look at that. And let's now start solving the financial reporting May 25 paper, starting from the first question. Now coming to the first question. This question was on business combination, pretty familiar question, professional and dynamic limited, but there are some adjustments which were slightly tricky because of the deferred tax implication. That is where we have to be extra careful. So let's start reading this. A Limited and B Limited are engaged in the manufacture of pharmaceuticals, no problem. On June 1st, A Limited acquired 15% of equity shares of B Limited. So here when 15% is acquired, you have some investment. This investment is as per Ind AS 109. On 1st of October, A Limited obtains control when it acquires further 55%. So, if you see the number of shares, 400 divided by 10, 40 lakh shares are there. 15% we already hold, another 55% has been acquired. The total holding becomes 70%. Okay. Fair value of shares of B Limited was 40%. Now, why is this fair value given? This fair value is given because you have to see what is the fair value on the date you have obtained the control. And that fair value will be used to determine goodwill. And not only that, what is the cost? Cost what they have given is 6 lakh shares acquired on 1st of June. The cost is 210 lakhs. Now you have 6 lakh shares at a valuation of 40. So 6 lakh shares into 40, 6 into 40 is 240 lakhs. So there is a gain of 30 lakhs. So that gain has to be recognized in P&L. Now, one more angle which a lot of you would have overlooked is when I am recognizing this gain of 30 lakhs, there is a DTL implication in the books of A Limited. And if you have not done that, that could be an error in the examination. Why DTL? Because my carrying amount doesn't change, but my tax base doesn't change, but my carrying amount changes to 240 in the books. So if I have recognized the gain, correspondingly, the deferred tax liability impact of that should also be recognized. Alright, then prior to the acquisition of 55% of stake by A Limited on 1st of October, the balance sheet of the two companies stood as under. So this is balance sheet before acquisition. Means what? Whatever purchase consideration we gave, whatever cash we gave, whatever shares we issue, all of that have to be recorded. That has not yet been recorded. Then other things are simpler: inventories, financial asset, trade receivable, cash, other current assets, non-current assets held for sale. Then you have equity and all of that. Then you have long-term borrowings provision, DTL, financial liability, short-term and trade payments. Alright, nothing difficult. Then, in consideration of the additional stake acquired by A Limited on 1st of October, it agreed to pay each selling shareholder of B Limited a sum of 15 per share in cash. So, whatever shares you have acquired, you will pay 15 per share in cash. How many shares did we acquire? We acquired 55%. So 400 into 55%, it becomes 220. into you pay 15 per share, that becomes 330. Okay, 330. Then issue one equity share of A Limited in lieu of 8 shares of 10 each held by the selling shareholder in B Limited. So we have 40 lakh shares into 55%. We are acquiring 40 into 55%, 22 lakh shares. This divide by 8 is the number of shares. So 22 divided by 8, number of shares is 2.75, multiplied by 160 is the share value for purchase consideration. That is simple. A Limited agreed to pay additional payment as consideration, that is higher of 35 lakhs and 25% of any excess profit in the first year after acquisition over its profit in the preceding 1 year made by B Limited. So here 35 lakhs is the minimum amount and 25% of any excess profit. The additional amount would be due after 2 years. B Limited has earned 10 lakh profit in the preceding year, 20 lakhs it will be earning in the next year. So if you see 20 lakhs into 25%, that is still a lesser amount. Higher value, that is minimum amount that has to be paid, is 35 lakhs. This you will discount by 2 periods and you will record it. A Limited also agreed to pay one of the promoter shareholders a payment of 15 lakhs provided he stays with the company for 2 years. Now this we have discussed multiple times. If it is for employment, you will not consider as purchase consideration, but please you have to write a note for this in the examination. A Limited had certain equity settled share based award. This is an error in the question. A Limited, this should have been B Limited, which was replaced by the new award issued by B Limited. So B Limited will be issuing. So it should not be, this is A. As per the original terms, the vesting period was 4 years, and as of the acquisition date, employees of B Limited have already served 2 years. As for the replaced award, vesting period is reduced to 1 year. So 1 year from the acquisition date, it will be completed. The fair value of the award acquisition is, original award is 5 lakhs, replacement award is 8 lakhs. So what we have to see, how much are we paying for service already completed? So that is 5 lakhs multiplied by how many years? To higher is 4. So 4 and 2 is completed. So 2.5 is the purchase consideration component and 8 minus 2.5, this is for your employee benefit. The fair value exercise resulted in the following. Fair value PPE and inventory was 480 and 170. You will adjust the assets and the difference will also result in deferred taxation. The carrying value of non-current asset held for sale of 250 lakhs represents fair value less cost to sell. So we'll measure this at fair value less cost to sell and not at fair value. B Limited has developed and patented a new drug for Parkinson's, which has been approved for clinical use. The cost of developing the drug is 140. Based on early assessment of its sale, the valuer has estimated the market value to be 200. Now 200 is the fair value we'll consider for acquisition accounting. There is no problem in that. The other problem is, now this 140 lakhs and they have said developing. Has it been recognized as intangible asset? The question doesn't have any information on intangible. Means what we'll assume, this 140 lakhs has been written off in the books. And now we are capitalizing 200 lakhs. This is okay. But when it comes to deferred taxation, how to consider? Because the carrying amount it will be 200. How much will be the tax base? Tax base we will assume this 140 lakhs has already been written off. It has already been expensed. So tax base is 0 and accordingly we will do. Sir, can we consider this 140 to be the tax base? We could have, but here we don't have anything which says that there is a intangible asset. It only talks about property, plant and equipment. So because we don't have information, we will consider 200 increase in fair value and tax base of 0. B Limited had a lawsuit for infringement of trademark pending with a competitor who made a claim of 50 lakhs. B Limited has disclosed the same as contingent liability as it is not probable that the amount will be payable. But when it comes to fair valuation, we will do the fair valuation even if it is not probable. Fair value is 10 lakhs. Any sum which would be paid in respect of the lawsuit would be tax deductible. So you will take the actual liability, fair value 10 lakhs and accordingly do the deferred tax implication. Cost of capital is 10%. This is used for your deferred consideration. Discount factor at 10% payable at the end of year 1 is 0.91 and year 2 is 0.83. The applicable tax rate for both the entities is 30%. Okay. Unless stated otherwise, all items have a fair value and tax base equal to their carrying amount at the acquisition date. A Limited chooses to measure the non-controlling interest as per proportionate share of identifiable net assets. Prepare the opening consolidated balance sheet as of 1st October as per India's working note should form part of your answer. So let us look at the solution. So here I have just put down the basic information. Total is 70%, NCI is 30%. Now what are the net assets on the date of acquisition? Equity share capital 400 from the question, other equity 225 again from the question. Fair value adjustment PP increased by 80, inventory increased by 20, fair value of drug is 200. Now please remember, on all of these fair value changes, you will also have a deferred tax liability. So how liability? I have always told, I'm repeating once again, that whenever you are looking at a gain, it will result in a liability. So 80 of gain, liability 24, 30%, 20 into 30%, 6, 200 into 30%, 60. Then we have contingent liability. We have a contingent liability that is now recognized at fair value. This will result in a deferred tax asset whenever we pay. So it will be a negative number. Okay. So why is it a deferred tax asset? Here because it's a loss. Then the net deferred tax liability will be the sum of all of these, which works out to 87. Now after you do all of that, you get the identifiable net assets at 828. That's the first thing. Then coming to purchase consideration, 330, 440. This contingent consideration, I had done 1.1 divided by 2 times. Actually, it should have been 35 into 0.83, which is 29.05 is the contingent consideration. Okay, so I'll just share that with you. When you download the file, you will get 29.05 only. Sometimes it happens. So here you can see it is 29.05, and accordingly the remaining calculations would also undergo a change. Here I have done assuming 28.93. In the actual solution, what you will download, you will get 29.05 itself. Then replacement award 2.5 that we have already computed. The total purchase consideration comes to 801.43, and if I use the actual number, it is 801.55. Fair value of existing stake is 240, and NCI is 248.40, which is the net assets ka 30%. Total is 1289, and goodwill comes to 461.83. If you use another number, it is 461.95. Okay, that is fine. Now this is the note I have written for intangible asset. Right. After this is done, coming to consolidated balance sheet, this it is more simpler. A limited, B limited, whatever is the fair value adjustment, you will get the total. Goodwill as per computation. Other intangible assets 200. Now these other intangible assets are your intangible assets of that drug development. Inventories 20 adjustment, no adjustment in trade receivable, cash and cash equivalents. Cash and cash equivalents, you have to reduce the amount paid. So what is the cash paid? Cash paid is 330. In the balance sheet we have cash of how much? We have cash of 400. We paid 330. So now the cash left is 70. Sorry. So that 70 you will consider, 100 you have taken over, 170. Other current assets and non-current assets held for sale, you get the total. Now coming to equity share capital, here is where it is important. We have issued 2.75 lakh shares, so that gets added here. Of 2.75 lakh shares into 60, 275 into 60, 165, that is your securities premium account. So this number is the securities premium account. Okay. Then SBB reserve, whatever has been paid, is under other equity 2.5. Then retained earnings, A limited they have given 810. There is a fair value gain on investment. There is a fair value gain on investment. That fair value gain on investment, we will record a gain of 30 because we have to remeasure the investment before we are converting that from a normal investment to a subsidiary. Okay. Now whenever there is a gain, this will result again in a temporary difference, and you will have a deferred tax expense related to that, which is 9, right? So your reserves and surplus becomes 831. All right. This deferred tax expense you should add to deferred tax liability as well. Coming to other financial liabilities, deferred consideration, if you take it 28.93 or 29.05. Now see, in examination, in a rush, if you had not read the discounting factor and you would have taken this, maybe they would give marks, but then we may end up losing marks as well. So why did I lose marks? Because I didn't read the discounting factor at all. I just thought 10% means just divide by 1.1, there is an Excel, I'll just plot the numbers. Okay, so that kind of mistakes we should not be doing in the examination. Okay. Then deferred tax liability, A limited was 40, DTL on acquisition was 87, and DTL on fair value gain of existing stake is 9, total DTL is 136. Those numbers you will plot it here. Equity share capital, other equity, non-controlling interest from the working note, long-term borrowings as it is, other financial liabilities is 28.93 or 29.05 is your deferred consideration. Then deferred tax liabilities 136, short-term borrowings, trade payables and other current liabilities makes a total of 4011.83, 4011.83. Now this was a simpler question. The question was not at all complicated, and even if you had missed out a couple of adjustments, you would have still scored good marks in this question, because calculation of goodwill, calculation of minority interest was not very difficult or not very challenging. So all in all, with a reasonable attempt, even if you have not done a couple of adjustments correctly, you would score somewhere between 8 to 10 marks in this particular question. Okay. Now moving on to the next question. This question was on modification of a loan. That is, you have to check whether you have to go for extinguishment accounting or modification accounting. Same question has been asked in the previous examinations also. So there is nothing new you have to be worried about here. Okay. 1st April they raised a loan of 5 crores, which will be paid 11% per annum on annual basis, and term loan will be repaid in 5 installments. Now the only thing here is, in the previous other examination question, and we have discussed this in our financial instruments revision also, there they have said that due to liquidity constraint, they were unable to honor the obligation of repayment of loan installment which fell due on 31st March. There they have clearly said they paid interest. Here the question is silent. Now what do we assume? Do we assume interest has been paid? Now what you have to read is, unable to honor its obligation of repayment of the loan installment means they had not paid the loan installment. Now that doesn't mean they have not paid the interest installment. Not installment actually. They have not paid the interest. That we cannot assume. We can only assume loan installment of 1 crore has not been paid. Okay, that is what should be the assumption. Then revised term 15%, and the loan will be repaid in 8 annual installment of 50 lakhs each, commencing from 31st March. No further cost has been incurred. You are required to record the journal entries from 1st of April till 31st of March. Okay, so very simple. Present value factors have also been given. Now funny thing here is, here they have given 3 factors. In another question, to compute fair value, they have given 4 factors. In the first question, they have given 2 factors. So how they have given, accordingly we have to take. Now coming to the solution, the first part is the original loan. Right, for this you have to prepare the schedule. You can prepare only up to 31st March also, but I prepared till this date. One is because I have Excel. Second is just to check whether there is any discrepancy. Right, original recognition of the financial liability will be at 4 crore 94 lakh 10,000, which is the upfront loan minus the processing fees. Interest at 11.5% on the opening balance. Principal repaid 1 crore and interest paid 55 lakhs. This interest is your 5 crores of loan into 11%. That is what will be paid. Expense will be booked at 11.5. Interest will be paid at 11% on the original value and the closing balance. See, this we have already discussed multiple times, even in the revisions, also in the past exam papers. Now, on 31st March of 25, what is the carrying amount? Now, the question has said that they have not paid the loan. So, we will assume they have not paid this 1 crore. So, instead of 297 closing balance, it will be 397. Now, what you will do? You will take the revised cash flow. Now what you will do, you will take the revised cash flow. What is the revised cash flow? See, the loan has now a balance of 4 crores. Okay, 4 crores. That 4 crores will be paid in principals of 5 crores each. And you will also pay interest on the opening balance at what? 15%. This total cash flow, interest plus principal, 50 plus 60, you will discount using the discount rate of 11.5% and come to the carrying amount. Come to the present value. Present value is 4 crores 44 lakhs. Carrying amount is 397. Difference is 47. More than 10%. So it is extinguishment accounting. You will extinguish the existing loan and you will recognize a new liability. Journal entries and all, you can have a look at it. Simple and straightforward. Then moving on to the next question. This one was an interim financial statement. Ditto question you can find in accounting standard 25. Same question you can find in accounting standard 25. You can have a look at it. These concepts you have learned already. I am not saying you have not learned the concept. But when you see the same question, confidence level increases automatically. So here 31st December of 24 Q3 is what they have referred to. Dividend income of 8 lakhs received during the quarter has been recognized to the extent of 2 lakhs only. How much did we receive? 8. How much did we recognize? 2. Balance 6. We have to make the adjustment. We have to add. 60% of sales promotion expense of 30 lakhs incurred in the third quarter has been deferred to the fourth quarter. So out of 30, 60% has been deferred. We have to recognize immediately minus 18 lakhs. 4 lakhs of extraordinary gain received in third quarter was allocated equally to the third and fourth quarter. So another 2 lakhs you have to account in the same quarter because you cannot defer it. Cumulative loss of 30 lakhs resulting from change in method of inventory was recognized in the third quarter. Out of this, 10 lakh relate to previous quarter. So if it is an inventory change, it's a change in accounting policy to be applied retrospectively. So 10 lakhs has to be applied to the previous quarter. So we have recognized 30 here, 10 has to be reversed plus 10. Sale of investment in the first quarter resulted in a gain of 40 lakhs. The company had apportioned this equally to the 4 quarters. 40 in the first quarter, you have apportioned equally 4 means 10 lakhs in this quarter. This has to be reversed minus 10. Okay. Minus 10. So let's see the solution. 8 plus 6 minus 18 plus 2, the gain not recognized, inventory loss of previous quarter, gain on sale of investment. So you get to the corrected profit of 18 lakhs. Now here also, if 1 or 2 adjustments went wrong, still you could have secured out of, I think it was a 4 mark question. It was a 4 mark question and there are 5 adjustments and correct profit number is the 6th adjustment. So maybe for every 2 adjustment you will get 1 mark and final number you will get some 1 mark. So still you would have been able to score 2 or 3 marks. Then moving on, 3A. Now this is on impairment. This is exactly similar to the question in Accounting Standard 25 illustration given in the bare text of the standard. Okay, I have this habit of reading the bare text of the standard even while teaching in the class, because sometimes we get some new points like the core inventory point what we discussed that came up from the educational material. Right, same way this Accounting Standard 25 question. Once the concepts are clear, we will be able to handle that in the examination. Tiny Limited deals in trading of cars. It became 100% subsidiary of Annie Limited on 1st of April at a purchase consideration of 64. At the time of acquisition, fair value of net identifiable asset was 51, goodwill was 13. So far so good, no problem. I have a problem here because they have used the term net identifiable asset and they have said life of Tiny Limited asset on 1st of April was estimated to be 15 years with no residual value. Now tell me one thing, what is net identifiable asset? This is your identifiable asset minus liability, that gives you net identifiable asset. I cannot depreciate this net identifiable asset. I need the breakup. How much is asset? How much is liability? That breakup is not given. If that breakup is not given, how will I compute the depreciation? As I showed you in the Accounting Standard 25 bare text, there they have used the term only, not net, only identifiable asset. Then it would have been correct. But they have not used. What will assume? This 51 crore is assumed to be the identifiable asset and accordingly we will charge the depreciation. On 31st March, the government issued new guidelines due to which Tiny Limited had to close few of its showroom. As a result, Tiny Limited's revenue was estimated to reduce by 30%. So there is a 30% reduction in revenue. This adverse change in marketplace and regulatory conditions indicated impairment. As a result, Annie Limited had to estimate the recoverable amount of goodwill and net assets of Tiny Limited on 31st March. No independent cash flows can be identified to any individual asset. So the entire operations of Tiny Limited was treated as a CGU, no problem. Due to regulatory entangle, it was not possible to determine the selling price. Its value in use was estimated by the management to be 35 crores. Value in use is 35 crores. Then, recently on 31st March, the government withdrew the guidelines on 31st March of 24. The management expects a favorable change in net cash flow. Recoverable amount of Tiny is limited. Net asset is re-estimated. Here they have started using net asset. Value in use is expected to be 54 and fair value less cost to dispose is 48. So what is recoverable amount? Higher of these two, 52 lakhs is the recoverable amount. Sorry, 52 crores is the recoverable amount. Calculate the impairment loss on 31st March and advise the accounting treatment for reversal. Now if you calculate the impairment loss, how do we approach it? Carrying amount on 1st of April is given. 1st of April of 22 is given. Goodwill 13, identifiable net asset. This actually is now only the net asset, total is 64. Depreciation, goodwill cannot be amortized. If you look at Accounting Standard 28 example, there it is amortized because under accounting standards we can amortize goodwill. Here goodwill cannot be amortized, so it is 0. And 6.8 is the amortization for net asset, that is considering a useful life of 15 years. So 51 divided by 15 multiplied by 2, you get this number. Okay, total. So now carrying amount is 13 for goodwill, 44.2, total is 57.2. Recoverable amount is 35. So the difference is impairment loss of 22.2. How will you write up? First, entirely goodwill, balance to other asset. So carrying amount after impairment is 35. How many useful lives is left? How many years of useful life is left? 13 years. So what we will do? 35 divided by 13, the depreciation will be charged at 2.69 per year. Okay. If we charge 2.69 of depreciation, carrying amount will become 32.31. Now 32.31, recoverable amount is 52. Is there any impairment loss? No impairment loss. There is actually a reversal. How much can be reversed? 52 minus 32.31. If I do, reversal is possible up to 19.69. But we know that reversal should not exceed the carrying amount after calculating depreciation without considering impairment. So depreciation for 24-25 without impairment is 3.4. 6.8 for 2 years, 3.4. Carrying amount without impairment on 31st March, basically 44.2 minus 3.4. 44.2 minus 3.4, we get 40.8. Maximum reversal is 40.8 minus 32.31 because the carrying amount cannot exceed, the carrying amount after reversal cannot exceed the carrying amount after charging depreciation, assuming there was no impairment. So the maximum reversal possible is 8.49. Now we have a useful life of 12 years, depreciation is 3.4. So that is how you have to answer. Then coming to the next one. This one, a similar question from the study material. Simple but very lengthy. Just 6 marks and you have to do a lot of calculations. So they have given income from continuing discontinued operation, weighted average number of shares, incremental common share due to stock option, calculate basic and diluted of EPS of A Limited and diluted EPS of B Limited. That is the question. Okay. Now basic and diluted, please remember you have to give for continued operations, overall discontinued. So generally the disclosure of discontinued operations is also required, right? So as done in the study material, we can do it in the same way. The other thing is for diluted EPS, what we need to understand is that diluted EPS, when we have to check only from continuing operation, not on net income after considering discontinued operation. Meaning to say, to check whether these options are dilutive or not, you have to consider this number. Income from continuing operation is what you have to consider. So here it is 360. When there is a loss, and if the number of shares increase, the loss per share decreases. So here it becomes anti-dilutive. Okay. So accordingly we can do the presentation. Continuing operations, discontinued and net income is given. Basic EPS from continuing operation, basic from discontinued and overall basic EPS. And for B Limited, if there is loss from continued operation, potential shares are not considered since it would result in anti-dilution and basic and dilutive EPS would remain the same, which is 1.52 in this particular case. Chimney purchased the machinery for 18 lakhs. With no residual value and it was reflected on 1440 on 1st of April. Now here we needed a trick to arrive what is the useful life. That is the only trick here in this question, and this most of you have done at CA foundation level itself. Okay, so I would call it a bonus question because though it is lengthy in calculations, you can see the calculations very lengthy. I did a detailed calculation to be doubly sure. You can do the calculation inside the machinery account also. The account itself is 1 year, 2 year, 3, 4, 5, 6 years is the account itself. And you have to be sure of revaluation. So here in this question, the only thing is the revaluation that we calculated initially upward revaluation of 8%, 1,15,200. This has to be transferred to retained earnings in the ratio of depreciation, that is on SLM basis over 8 years. So every year you will transfer 14,400 to what? To retained earnings. Sir, why is this important? This is important because when you do the downward revaluation, you have to see what is the balance in revaluation surplus. Okay, that is where it is important. Our original revaluation surplus is 1,15,200 that you can calculate on your own, or you can just see the cost of machinery 1440 was the carrying amount. On this 1440, 8%. So 1440 into 8%, if I do, I get 1152. This surplus every year I'll transfer to which account? Retained earnings account. So in 2 years, how much did I transfer? 28,800. So from 115,200 minus 28,800, my balance in revaluation surplus is only 86,400. Subsequently, when I do a downward revaluation, to this extent, I will write to retain earnings, balance will go to P&L. So like here, if you see, revaluation reserve 86,400, P&L, the balancing number would go off. Okay, very simple calculation. You can, run through this. I don't think this needs a explanation, especially because you have been doing this right from 11th, 12th, foundation, inter, and final. Then we had this question on share-based payment where there is a liability, SAR, 1000 stock appreciation rights to each of the employees, 160 employees on 1st April with a fair value of 100. 8 marks question, simple and straightforward, but very lengthy because they have given a modification part also. Now these are the type of question where you can score 8 out of 8, but it will take more time. You cannot finish it off in 8 into 1.8 if you do 15 minutes. Very difficult. You would have taken at least 20 to 25 minutes to finish this. But the advantage is 8 marks out of 8 marks is in your pocket, because here there is no complexity. They have said everybody will exercise. Even in modification, 100% will exercise. So that is why this becomes a simpler question. So you have the number of employees, number of SARs per employee, total is 160, fair value is calculated, 4 years of vesting period, so you get the cumulative expense. Expense already recognized, 48, 104 from here and 162 balance to be recognized. Journal entry, debit employee benefit expense, credits SBP liability for SAR, P&L to employee benefit expense, and then when it is settled, SBP to bank. It should not be 62 lakhs, there is a mistake here, it has to be 2 crores 24 lakhs. Okay, this number is 2 crores 24 lakhs, that is settled. If the terms are revised at the end of second year to require only 3 years, then first year you will do for 4. From second year you will consider 3 years. So 2 years completed out of 3. Based on that, your cumulative expense will change, and finally this number will also change. Accordingly, we will do the calculation. So here it is 2 crores 16 lakhs of payment. Okay. Then Hasso Limited deals in manufacture of computer hardware and development of software application. 5 marks only, 115, surprising. Discuss the revenue recognition as per Ind AS 15. Grahak purchases a software application from Hasso for 2 lakhs. Under the agreement, Hasso will provide updates. Grahak can choose whether to install them or not. Hasso will undertake no other activities that will change functionality of the software. So here there is no expectation from Mr. Grahak that you have to give them updates, because they can choose whether to install them or not, as and when, if available basis. So there is no continuation update also happening. So here it is more like a right to use as per Ind AS 115, the intellectual property right of use category, and sale will be recognized immediately. In the second category, Hasso will have to maintain the brand through product improvements and campaigns. This is more like right to access, and this will be recognized over a period of time. Okay, same questions picked up from the study material. Here comes the next one, which is of 2 companies which are extracting coal and minerals, and they own and operate independently of each other. They came together to jointly acquire luminous coal mine in the ratio 55-25. Decision requires unanimous agreement of both. No separate entity is incorporated. So first one here is discuss whether it is a joint operations or joint venture. Now friends, when entity is not incorporated, there is no separate entity, it will fall in the category of joint operation. And also you have to write whether there is joint control or not. Here, because they say they require unanimous agreement, there is a joint control. Okay, that's it. Discuss the accounting for unextracted coal and mineral as per Ind AS 16 and Ind AS 37 with respect to aforesaid luminous coal mine. Now here there is also a decommissioning. There is also a decommissioning obligation, and machines can extract only up to 95%. Remaining coal is irrecoverable, and remains in the coal mine. Now this is a part where you have, if you had understood the concept, or if you had learned the concept, it would have been easy. Core inventory which is not recoverable is considered as a part of PPE. So this, what happens is when you have a coal mine, right, or if you have let's say a pipeline, you need to maintain some minimum level of inventory which you cannot use, which you cannot extract and sell. The cost of that is considered to be a part of property, plant and equipment, because that is a cost I have incurred. Without that cost, I will not be able to operate the PPE. So here, because it is not recoverable, Ind AS 16 is applicable, and hence I will capitalize that. And for decommissioning, I'll create a liability as per Ind AS 37 and add that to the cost of PPE as per Ind AS 16. Assuming operating cycle of 12 months, very simple. Electricity deposit paid permanently. This, though it can be refundable on demand, but permanently, and we may not ask for refund, this is non-current. Tender deposit next 6 months, current. GST demand deposited, appeal will be in June 26, non-current. 31st May 26, only on completion, this also is non-current. Discuss the limitation, this you can refer to the theory. 5 impacts of blockchain and financial reporting, again you can have a look at the theory. Then manufacturing process of Milky Way, one byproduct universe has emerged beside Galaxy 1 and Galaxy 2 and scrap. Same question, ditto MP1, MP2 question, which I have told so many times. Again, they have done the same thing, just that here it is, actual question is 250, 100, they have just flipped this. This you can have a look at the solution directly, and I think you'll be able to compute that as well. Here I have not added reasons, you can just look at the material and get to the reasons, and this is for 6B. And lastly, 6C, here it is valuation of the business as per Ind AS 113 using the income method. Here there is no difficulty as such, only thing is they have said the total number of shares as on the measurement date is rupees 20 lakhs. Now, is it 20 lakh shares or rupees 20 lakhs worth of share? I have assumed it is this rupees has come extra, 20 lakh shares, and accordingly I have solved the question. That should not be a challenge for you to solve the question. Okay. So what I'll do is the PDF of this is available in the comment section. If you have any dispute, please ask. I'll be more than happy to respond to that. Hope you liked the discussion of the solution. Do share it with your friends, and again requesting you to subscribe to the channel because if you have reached to this place, it's definitely you have liked the video. Thanks a lot.